Think about a heavy rubber band, right? Stretched to its absolute breaking point.
Oh, yeah.
You are just waiting for it to snap. And that tension has basically defined the global market for months. But today, Tuesday, April 14th, 2026, somebody finally let go, and the entire system just violently snapped upward. Welcome to the deep dive.
Glad to be here.
We are unpacking today's massive stock market rally under the current Trump administration and really looking at how you can navigate what actually comes next.
Because the sheer scale of today's surge is, it's historic. We aren't going to just redo a spreadsheet. But to set the baseline for today's close, the Dow blew past 48,535.99.
Right.
The S&P 500 closed at 6,967.38, and the NASDAQ 100 hit 25,842 flat.
And it wasn't just a U.S. tech rally either, was it?
No, not at all. Over in Europe, the DAX hit 24,044.22, and the FTSE 100 climbed to 10,609.06.
Wow.
Yeah, and looking at the Asian baselines, the Kospi finished today at 5,967.75, just a completely synchronized global leap.
Which really begs the question, why today? I mean, markets don't just globally coordinate a jump like this by accident.
No, they don't. Two distinct catalysts collided today. First, the geopolitical pressure valve finally released. U.S. Vice President J.D. Vance reported progress in negotiations with Iran.
Okay, so just looking at that objectively, market algorithms saw that news and immediately priced out the worst-case oil shock scenarios.
Exactly. And that directly explains the European surge today. When the threat of a massive energy spike vanishes, European manufacturing and supply chain costs become predictable again.
Right, and that predictability is the exact mechanism that brings institutional money flooding back into indices like the DAX and the FTSE.
You nailed it. And then you add the U.S. March Producer Price Index, the PPI, cooling down to 4.0% today.
Oh, which completely cements the hopes for interest rate cuts.
Exactly.
Putting those two things together, it really makes me think of Dentrer-Dueck's theory on market psychology. We didn't see a slow, rational recalculation of corporate earnings today.
No.
The entire system just instantly switched from a panic-driven system to a boom-driven system.
Yeah, and the quantitative models completely back up that psychological switch. We ran Markov chain Monte Carlo simulations right after the close today.
Right, which is basically a statistical tool that runs thousands of different future scenarios based on today's momentum shifts.
Exactly. And looking past April 14th, the targets for the end of the month are, well, they're incredibly aggressive.
How aggressive are we talking? Give us the numbers.
Well, the models project the Dow climbing to 50,500, S&P 500 aiming for 7,250, and the NASDAQ hitting 27,200.
Okay, and what about overseas?
In Europe, they target the DAX at 25,200 and the FTSE pushing up to 10,950.
And Asia, because you mentioned the Kospi earlier.
The projected upside in Asia is massive. The Kospi is aiming for 6,400 and the Kazakh for 1,210. Plus, the Shanghai Composite, the SSE, is eyeing 4,250, and the Hang Seng is targeting 27,500.
Hang on, I have to challenge those numbers a bit. If we look at Aswath Damodaran's theories on corporate life cycles, he warns against pricing companies based purely on macro stories.
Right, that's a very famous warning.
So are these massive targets actually supported by current profits, or is the market just blind buying the AI growth narrative again because the geopolitical fear is gone?
It's a great point. Damodaran's warning is totally valid for mature cash cow companies. But the models suggest this current market is structurally different.
How so?
Well, for the high-growth tech and semiconductor firms driving the NASDAQ and the Kospi, their entire valuation relies on borrowing money cheaply to build future AI infrastructure.
I see.
So when inflation cools and geopolitical risks drop like they did today, their future cash flows suddenly become mathematically viable again. The narrative essentially becomes the math.
Okay, so if that momentum is locked in, how do you actually deploy capital without getting caught off guard if the rubber band snaps back? Let's talk about the 2026 Safe Return monthly quantitative strategy from our sources.
Yeah, the blueprint for that allocates 70% to long equities, specifically targeting U.S. tech, Korean semiconductors, and European cyclicals.
Okay.
Then you put 20% in long bonds and keep 10% in cash or alternatives as a hedge.
But the execution rules are what really make this interesting. Like, you buy Korean index leverage, say the KOSPI 200, but only on a 0.5 ATR breakout.
Right.
For anyone unfamiliar, ATR stands for average true range. You're basically waiting for the asset to push past its normal daily volatility before you buy.
Yeah, exactly. So you aren't just faked out by random market noise. Furthermore, The strategy includes a hard, non-negotiable risk-off trigger.
Oh, this is the best part.
Yeah, if West Texas Intermediate oil jumps 5% in a single day, you liquidate 50% immediately. No exceptions.
And that mechanical rule is brilliant because it protects you from yourself. You don't just sit there checking news feeds hoping the oil spike is temporary. You let the data manage your risk.
Exactly. Today effectively marks a systemic reboot. The global market has transitioned out of inflation-driven fear and straight into a phase of technological optimism.
Which leaves us with something deeper to chew on. If our global markets can reprice future potential this rapidly just because a collective sense of relief washes over the algorithms, are you investing in the concrete reality of these companies anymore?
That is the million-dollar question.
Right. Or are we all just participating in a massive self-fulfilling loop where our collective optimism actually creates the reality we are betting on? Something to think about. Thanks for joining the Deep Dive.